spikes overnight. Missiles fly across headlines. Markets open down 2% before you've even had coffee. And suddenly, every finance channel is screaming, reposition now, defense stocks, energy breakout. This changes everything. But here's the uncomfortable truth. When global tension rises, like what we're seeing between the US and Iran right now, most investors don't lose money because they picked the wrong sector. They lose it because of something way smaller, something boring, something almost invisible. 1%. And if you ignore it in moments like this, it compounds against you for decades. Let me explain. Because this tiny number becomes even more dangerous when the world feels unstable. Think about how you feel during global tension. Oil prices jump, defense stocks rally, tech dips, then rebounds, then dips again. Your brain says, do something. That's normal. But here's the part no one tells you. Volatility exposes inefficiency. When markets are calm, high-cost ETFs quietly leak. When markets are unstable, that leak becomes pressure. Imagine you own two broad market ETFs. Same index exposure, same economic backdrop, same market recovery. One costs 0.20%, the other costs 0.85%. During volatile years, both fall, both recover, but one drags harder, recovers slower, compounds less. Not because it picked the wrong stocks, because it kept less of the rebound. And that's where the story shifts. Because now we're not talking about fear, we're talking about structure. And structure is what survives crisis cycles.
Here's the rule. Add expense ratio plus tracking difference. If it pushes toward or beyond 1%, pause, not panic. Why 1%? Because once total drag creeps toward that level, you're entering a zone where compounding math starts working quietly against you. Let's walk through it simply. Imagine $100,000 invested for 30 years. Average annual market return 8%. If you pay 0.2% in total cost, you net roughly 7.8%. If you pay 0.8%, you net 7.2%. That 0.6% difference doesn't look scary until you stretch it across 3 decades. Now the difference can reach 6 figures. 6 figures. And you never felt it happening. That's the twist. Investors obsess over dramatic crashes, but long-term wealth erosion usually looks boring, quiet, systematic, predictable. And here's where it gets more interesting. Because cost alone isn't the villain.
Tracking error doesn't sound exciting, but it matters more during unstable periods. When markets get volatile, funds with higher turnover or looser replication can drift further from their intended exposure. That means you think you own one thing, but you're slowly holding something slightly different. In stable markets, that drift might barely show. In high-tension environments, rising oil, geopolitical uncertainty, inflation risk, small tracking differences can widen, and that widens outcome gaps. So the 1% rule isn't about being obsessed with tiny decimals. It's about asking, is this ETF engineered for efficiency or marketed for excitement? Because here's the uncomfortable reality. Many thematic ETFs launched during hype cycles cost 0.70%, 0.85%, even above 1%. And they weren't built for 40-year holding periods. They were built for attention. Which brings us to the real question. What actually builds something that lasts decades?
Zoom out. Way out. Forget this week's oil spike. Forget the next election. Forget the next recession headline. Think 40 years. Imagine a simple investor. Nothing flashy, just disciplined. Broad exposure, low turnover, low cost, annual rebalance. Done. No chasing, no rotating every 6 months. Now compare that to someone constantly shifting because headlines feel urgent. Energy this year, defense next, AI after that. Emerging markets because oil tensions change the trade routes. One strategy feels active, engaged,
in control. The other feels boring. But over decades, the boring one often wins because it preserves efficiency, and efficiency compounds. Not dramatically, not loudly, but relentlessly. And here's the part most people miss. You don't need a miracle year. You need to avoid structural drag for 30 to 40 years. That's how generational wealth forms. Not from prediction, from preservation. But let's bring this back to today, because this isn't abstract. Right now, geopolitical risk is real. Oil volatility affects inflation expectations. Inflation affects interest rates. Interest rates affect equity multiples. It's all connected. So what's the investor's job? Not to forecast missile paths, not to trade headlines. It's to reduce controllable friction. Open your brokerage account. Look at your ETFs. Ask, what's the expense ratio? What's the tracking consistency? What's the turnover? Add expense plus tracking drag. If it's under 1%, you're likely in a structurally reasonable zone. If it's pushing above that, ask why. Is the exposure unique? Is the diversification meaningful? Or are you paying for narrative? Because when the world gets loud, efficient portfolios get quiet, and quiet portfolios compound better. Remember the oil spike, the tension, the volatility? Those events will come and go, but the 1%, it stays. Every year, every cycle, every recovery. You can't control geopolitics. You can't control markets, but you can control drag. And in long-term investing, control beats prediction. If this helped you think differently about ETF selection, subscribe. Next, we're breaking down how asset allocation interacts with this 1% rule, because even a low-cost portfolio can fail if it's poorly structured. And that's a mistake most investors don't realize they're making until it's too late.